You know that feeling, right? That sinking feeling when you spot one cockroach in your kitchen because you know for a fact there are dozens more you can't see hiding in the walls? Well, on Wall Street, they have a name for that. It's called the Cockroach Theory. And right now, some of the biggest names in finance are starting to see them. So today, we're going to flip on the lights.
Okay, let's just break this down. This is the quote that's got everybody talking. When Jamie Dimon, the head of JP Morgan Chase, starts using a word like cockroaches, he's not just trying to be clever. He is sending a very, very clear signal. He's tapping into that old Wall Street adage, there is never just one. It means the small, so-called isolated problems we keep hearing about. They might just be the tip of a much bigger, much nastier iceberg.
And that right there is the big question, isn't it? What is he seeing that the rest of us might be missing? That's what we're going to dig into. We're going to follow the trail he's hinting at and see if we can piece this puzzle together. Because it looks like a serious storm is brewing in a part of the market that's gotten huge, mostly by staying out of the spotlight.
All right, so to really start this investigation, we need to wrap our heads around what we're actually dealing with here. And trust me, this isn't some tiny niche market. This thing is an absolute monster, and it's been operating in the shadows.
So, what even is private credit? You know, the easiest way to think about it is this. If the stock market is like a big, bright department store where everything has a public price tag, then private credit, well, that's a deal done in a back room. It's where big investment funds lend money directly to companies, completely bypassing the banks. And because these loans aren't traded out in the open, it's really, really hard to know what they're truly worth. And forget about selling one with the click of a button. It just doesn't work that way.
Now check this out. For as long as I can remember, the junk bond market was the big casino for high-risk corporate debt. But look at this chart. A massive shift has happened, almost completely under the radar. The private credit market has ballooned to $1.8 trillion. It is now bigger than the entire U.S. high-yield bond market. That is a staggering amount of risk that has basically just walked out of the regulated banking system and into the dark.
And this slide, this just lays it all out, the difference between these two worlds. You've got the public markets on one side, transparent, liquid, you know the price every single day. And then you have private markets, completely opaque. And this is where it gets really dangerous. In the private market, fund managers can use what's called stale pricing. I mean, just imagine trying to sell your house today using a price from 2 years ago, before interest rates went up. It's crazy, right? But that's what stale pricing is. It lets these funds pretend their assets are worth way more than they are, which hides all the problems until it's way, way too late. Okay, so this brings us to the first giant red flag, the first cockroach, if you want to call it that. For a lot of investors, the pitch was pretty slick. Hey, you get these awesome private equity-like yields, but don't worry, you can get your money out whenever you want. But what happens when everybody wants out at the same time? Well, that's when that promise of easy access to your cash turns into a total mirage.
And boom, this is where the official story just completely falls apart. The industry will sit there and tell you everything's fine. Look, our non-accrual rate is only 2.2%. Now, that's just a fancy term for loans that are late on payments, but the fund hasn't quite given up on them yet. But when an independent rating agency like Fitch actually gets in there and crunches the real numbers, they find the actual default rate, we're talking companies that have truly gone under, is a whopping 9.2%. I mean, that's not a small discrepancy, that's a canyon. And it tells you the risk here is being massively, massively understated.
But here's the real kicker. Even if a fund's loans look okay on paper, there's this other hidden trap. The biggest danger isn't just that you might lose some money on a bad loan. No, it's that you might not be able to get to your own money at all. When people get nervous and start asking for their cash back, these funds have rules in the fine print that let them just slam the exit door shut, trapping you and your capital inside. And this isn't theoretical. Look at this example from BlackRock, the biggest money manager on earth. In the first quarter of 2026, investors in one of their big funds tried to pull out 9.3% of the fund's assets. BlackRock gave them back 5%. That's it. Everyone else was basically told, sorry, try again later. Can you imagine if your bank did that? And it's not just an isolated case. Over at Morgan Stanley, same time period, investors made a run for it. The fund was only able to cough up 45.8% of what they asked for. That's less than half. I mean, let that sink in. For every single dollar you wanted back, you got 45 cents. And then you have the most extreme case of all, Blue Owl Capital. They didn't just put up a gate. They didn't just limit withdrawals. They froze them permanently. The doors were literally locked, trapping billions of dollars of investor money with no end in sight. this is what happens when that liquidity mirage evaporates.
Okay, but let's say a loan does go belly up. What do you actually get back? Well, according to data from the Federal Reserve, not much. With a more traditional loan from a group of banks, you might recover about 52 cents on the dollar. But with these private loans, you're looking at just 33 cents. And why is that? It's often because there aren't any hard assets, like buildings or equipment, backing up the loan. So when the company fails, there's just nothing left to sell.
So we've seen the rot inside these individual funds, but how does this kind of problem become a threat to the entire financial system? Well, in today's interconnected market, nothing happens in a vacuum. One failure can set off a nasty chain reaction, just like a line of dominoes tipping over. So how does the contagion actually spread? It's pretty straightforward and it's scary. It all starts when one big fund, like those ones we just looked at, slams the gate on withdrawals. That immediately spooks investors in all the other private credit funds, right? And that kicks off a massive rush for the exits across the whole sector. Now, to get cash to pay people back, the funds have to sell their assets. It's a fire sale. But remember, you can't just sell these loans on an exchange. They have to find buyers in a panic. That means they take huge losses, which immediately devalues all the similar loans that all the other funds are holding. And that just creates this vicious downward spiral. That, my friends, is the definition of systemic risk. You know, this quote just hits the nail on the head. Nobody wants to be the person screaming the sky is falling for no reason, but you definitely want to be the one who pays attention to the canary in the coal mine, that early warning sign. Jamie Dimon's cockroach comment, those redemption freezes, the messed up default data, these are all canaries. The whole point is to see these warnings so you can react, so you're not caught completely flat-footed when things go wrong. Okay, so we've laid out all the evidence, we've seen the risks. The big question now is, what does all of this actually mean for you, for your portfolio? How do you make sure you're not the one left standing in a dark room when the lights suddenly switch on? Here are 4 direct, no-nonsense questions you need to ask your financial advisor. And look, don't let them off the hook with a, let me get back to you. First, what is my fund's direct exposure to illiquid private debt? Because here's the brutal truth. A ton of funds labeled high yield are quietly stuffing up to 40% of their portfolio with this stuff. Second, how do you value these assets? Challenge them. If you can't sell it, how do you really know what it's worth? Third, what are the exact rules for me to get my money out? Demand they show you the fine print on lockups and redemption gates. And finally, number 4, and this is so important, what percentage of the companies in this fund are paying their interest with more debt? It's called payment in kind or PIK interest. It's an accounting gimmick that makes a sick company look healthy right up until the moment it dies. You have a right to know these answers. You know, when you boil it all down, it really comes to this. That promise of a high yield, it can be blinding. It can make these risky, shadowy assets look just as safe as something you can buy and sell every day. But financial markets don't stay dark forever. They never do. Eventually, the lights always come on, and it's usually sudden. The only question you need to be able to answer is, when they do, will you know exactly where to find the exit?